All right, good morning, good afternoon, and good evening wherever you are in the world. My name is Stephen Place. I am the founder and head trader at investingwithoptions.com. I want to thank you for taking time out of your weekend to go to this financial seminar. It is a privilege and honor to be speaking with you, so hopefully my goal is that you will be able to create aggressive and sustainable wealth through options trading and investing. Today we're going to be talking about how to earn 30% in your portfolio without needing to time the markets. Okay, that is the goal of this presentation. We're not, options, we're going to talk about options. Options can be complicated, and we can get too bogged down in the textbook definition of options and all those fancy things. We're going to get into the nitty-gritty today and talk about the strategies that I use to attain this goal. So here's a little bit about me. That's my, that's what I look like. I've been a full-time trader since 2009. I started investing with options.com in the middle of a market crash to provide guidance and trade ideas to people across the world. My talent is understanding how options work, how options are priced, how the price of options move, and overlaying that with technical analysis. Now, I am a hybrid options trader, which means I trade directionally and I also trade non-directionally. We're going to be talking about the second kind of trading today, non-directional trading. Before we start, this is just a simple disclaimer. This is a bunch of legalese simply stating that you are responsible for your wins and your losses. I'm not a registered investment advisor. I'm not a broker-dealer. I'm not advising you to buy or sell securities of any kind. Do your own due diligence. Take control of your own financial destiny. No one cares about your money more than you do. What we're going to talk about to start off is how I had a near-death, several actually near-death experiences on a trip to Costa Rica and how this changed my investing style completely. So it was around 2013, February of 2013, and I had some friends that were down there to escape the winter, and so they invited me down, and my wife and I went. We flew into Liberia, and our plan was for them to pick us up at the airport and for them to drive us to a coast town on the west coast called Tamarindo. Except they decided to surprise us and take us to La Fortuna instead, which is in the middle of Costa Rica. Now the problem was they were a little late getting to the airport, and this was around 8 or 9 p.m. and the airport was closing. It's a smaller airport, and so we said, all right, we're just going to take a shuttle and we're going to take an hour trip from Liberia to Tamarindo, and then we'll just meet up with them there. Well, since they were going to go and surprise us and drive into the middle of the country instead of the coast, they had to go and pick us up. So it was around 9 p.m. And then maybe about an hour later when we finally found them, because my cell phone wasn't working at the time and I had to borrow someone's Wi-Fi and get on Skype and finally call them. And around 9:30, 10, they picked us up from Liberia and they started driving towards Cañas, which is the turnoff to get to La Fortuna. Okay? Now, here's the problem. The person who was driving us is from Detroit. He is not a native Spanish speaker. I was the only one in the car that spoke any kind of Spanish, and there aren't well-marked road signs in Costa Rica at all. The only good geographical markers were the rivers, and the rivers were very well marked. So what happened is, around midnight, I guess, we missed our turnoff, and we overshot the turn, and we ended up basically halfway to San Jose, which is the capital of Costa Rica. Now, it's around 1 a.m. or 2 a.m. around this time, and there was a roadblock. We were basically the only car on the road, and there was a roadblock by the Costa Rican police. And I'm the only one that spoke any kind of Spanish, and they're asking for passports, and our driver doesn't have a passport right now because it's in La Fortuna right now. And I'm pretty sure they wanted a bribe, but because we didn't speak that much Spanish to begin with, they felt sorry for us and put us on our way. Now, I asked them in my broken Spanish which way to Arenal, which is the mountain we're trying to get, and they said, oh, you have to turn around and drive another hour back and look for that turnoff because we missed the turnoff. Now, the car we're in is a Toyota Yaris, and I'm 6'7", I weigh about 250 pounds. So I'm built like a tight end, basically. And I'm in the back of this Toyota Yaris with my wife and our luggage. And I'm cramped, and I'm basically wishing death because my back hurts so bad from driving in this small car and being on a plane all day. And the road up to La Fortuna is it's basically a mountain pass. It's a series of several mountain passes, and our driver, who's from Detroit, who's driving a stick shift Yaris up a mountain in Costa Rica incredibly aggressively with no guardrails. We can't see off the side because it's so dark, but we know we're up on a mountain. And that's pretty terrifying. It takes us all night to get to the place that we need to go, which very nice hotel in Costa Rica, and you know, it's around sunrise. We get there at sunrise. We can see the sun rising. We're exhausted. We go sleep for about an hour and a half, and then we get up and we go back into town. Except we can't take the bridge back because around sunrise, there was a triple homicide. And if we had been 20 minutes earlier, 20 minutes later, we would have been privy to a triple homicide. Now, this doesn't happen in Costa Rica that often. Costa Rica is the happiest place on the planet by many measures. And it actually shocked the town that this did happen. But there was a triple homicide on the only bridge that led into our hotel. And that was one of many near-death experiences there. We also could have driven off the road. I also had a wicked case of walking pneumonia, basically, where I couldn't stop coughing. And so it was an incredible experience. And it was a hard experience, but it's one of those where I get to tell the story time and time again. Now, this is where it comes back into trading, because this trip drastically changed my trading style because I got smoked on some trades. And this was a function of not just the lack of sleep and me being sick and me being in a foreign country. It was the hubris that I had that income trading, that this style of trading we're going to be talking about is some kind of set and forget strategy where you can be some dummy with a laptop on a beach consistently and passively making money. That's not how this game works. So what we're going to talk about today, the hard math on how to make 30% or more in your portfolio with income trading, this non-directional income trading we're going to talk about. The three kinds of trades that can get you these returns and the mistakes that you must avoid with this trading style. These are the mistakes that I've made, and since I have removed those mistakes and created solutions to those mistakes, my returns have become much, much better. So let's talk about some realistic results. When someone says, you know, I made 30 to 50% a year on my portfolio, that's really freaking good. You know, our goal as investors and as traders, first off, is to have a non-negative return. We don't want to be losers. We don't want to have losing portfolios. The first step you must make if you're brand new to trading is not to become a profitable trader, but to become a break-even trader. You want to go from losing to break-even, then from break-even to winning. Okay? One of the skills that I have when I teach people is to get them from losing to break-even as fast as possible so they can develop the proper psychology to become profitable option traders. Now, 30 to 50% a year sounds really, really sexy. Most funds can't do that. Most investors can't do that. But if you say, oh, I'm looking to make 3 to 5% a month, that sounds really boring. And it can be. Boring is nice. Boring is good. Boring is what you want to happen, because if you can grind out 3 to 5% a month in your portfolio, you're going to be doing very, very well. It just doesn't sound like a lot initially, but as it adds up, as you get those cumulative returns, then you get the results you want on a longer-term basis. We want to think about being long-term greedy. That's a term from Goldman Sachs, long-term greedy. So let's do the math. This is called the 20 and 20 rule. This is what I like to use to dictate my position sizing with these kinds of trades. Let's assume that this blue box is your total portfolio. The goal is to make this blue box bigger. Okay, it's to grow your portfolio through aggressive and sustainable wealth. Oh, thank you. Slides aren't moving. I'm looking at the wrong thing. Okay, here's your portfolio. We have this blue box. We want the blue box to get bigger. This is the 20 and 20 rule. Let's take 20% of your portfolio. And what we want to do is we want to grow that 20% by 20%. If we can grow 20% of your portfolio by 20%, the 20 and 20 simply means 4% of your total portfolio. This is important. This is critically important because when you do trading, it's a function of risk management and position sizing that will keep you out of trouble. You don't want to be putting 100% of your portfolio into a single trade. That doesn't make sense. That's poor risk management. A good goal for non-directional income trading is to take 20% of your portfolio every single month and put it into trades that you expect to make 20% returns. Now, what's cool about this is, if you do the math right here, and if you can, if it's every single month, and you're working with a 2-month rolling window, that only ties up 40% of your portfolio, which means if you're a directional trader already, you still have at least half of your portfolio left to still do directional trades, to still speculate on stock timing or market timing or whatever you want to do. This is the 20 and 20 rule. If you can make 20% returns on 20% of your portfolio every single month, you're going to have a good year. That's the math that we're dealing with. Now let's make it a little bit more realistic. Let's say you're making 4% a month. If you did that every single month, you'd be up 48% a year. Let's assume that you have 2 losing months that are equivalent to the gains that you get every single month. So 2 losing months of minus 4%, that takes your yearly returns down to 32%. Now, this doesn't include compounding or anything like that. If you take into account slippage and commissions, you're right around 30%. Okay? So now the question is not how, the question now, we've done the math. It's not how to make 30%. It's how do we find stuff that moves 20% every single month. And if you come from a directional trading background, this is hard to understand. How can I pick stocks that are going to make 20% in a month? Now, if I knew how to do that, I would open up a hedge fund and I would make lots of money. But it's incredibly difficult to find stocks, to buy stocks that move 20% in a month that gives you good risk reward. Now, obviously, you can use leverage and you can find stocks that move 5% in a month, but they can also move 5% to the downside very quickly. There's a lot of volatility in directional trading. You could also use directional call options or directional put options, which can easily make 20%, but they can also very quickly lose 20%. We're looking for good risk-adjusted returns. Now, if you're new to stock trading, if you're new to options trading rather, you have to understand the market that we trade is not the same as a stock market. A stock market is where companies go out and they raise capital in order to fund operations. The bond market is where governments and corporations issue debt in order to fund operations. So the bond market is a debt market. The stock market is a capital market. The options market is a risk market. If you don't understand how risk works in the options market, and if you don't understand how risk is priced and how those prices move, you're not going to have a good, distinct edge in options. Odds are you're just using options for leverage and you're being a leveraged stock picker. There's nothing wrong with that. That's just very hard to do. If you're an amazing market timer already, yeah, throw some leverage on, but we're looking for better risk-adjusted returns. So the subset of strategies that we're going to be looking at are volatility trades. So you can, if you take every single options trading strategy in the world, you can split them up into a couple different buckets. The first bucket is directional trading. That's where you're basically using the delta of an option and maybe the gamma of an option. Those are known as option Greeks. You're basically looking to profit based off of the stock price movement. Okay, the options are derivatives. They are derived from different things. So an option price is derived from the underlying stock as well as the odds that it will be in the money by expiration. So that's the delta. We have another subset of strategies called volatility trades. And these are where you're not looking to make money from changes in the stock price, but you're looking to make money from changes in the volatility. There's actually two kinds of volatility. The implied volatility, that's what the options are pricing in, and the actual volatility, that's what's happening in the market right now. It's also known as the historical volatility. Way too many traders get hung up on the implied volatility, and they completely forget about the actual volatility. The actual volatility is where the risk is if you're doing directional or non-directional income trading. So there's a subset of volatility trading called income trading. This is where you're looking to profit based off of the option premium going lower. The option premium going lower can happen two ways, either through time or through changes in implied volatility, changes in the perception of risk. So let's go into that a little bit further. There are two things that cause the option value to move. Remember, in order to be profitable in option trading, no matter what strategy you're looking at, you need to understand what changes the price of an option. And if you can make money, if you understand what changes the price of an option, you can make money from speculating on that price change. That's our game here. We have the intrinsic value of an option, and that's related to the underlying. Okay, that relates to the price of a stock and where it's moving. And then anything left over is the extrinsic value of the option. The extrinsic value is directly related to the odds. It's directly related to the risk, and that's where we're going to be playing. Okay, that's, in my opinion, that's where option traders are going to make the most money. So the intrinsic value can be changed only through one way. That's the change in the stock price. That's known as the delta. And then the extrinsic value, we have the change in the stock price related to the odds. And then we also have time. And then we also have the change in perception of risk. So if we look at how we make money in income trading, it's mostly going to be through time. Okay, and this is critical. We can get into some advanced stuff. I'll just do a sidebar for those that actually know what I'm talking about right here. Most of your gains from income trading are going to be from theta. That means implied volatility does not matter as much as you think. And if you're just looking at options that have incredibly high implied volatility and completely forget about the actual volatility in the market, you're not going to make a lot of money. You're going to get blown out on your risk. Okay? In my opinion, a lot of people don't understand that critical concept. Even if you're doing covered calls and put sales and you think, oh, the implied volatility is very, very high, the premiums are very, very high, I can't wait to sell it. Well, you forget about the actual volatility. That's where you get blown out. So when we talk about non-directional income trading, here's how we make money through time. If we try and visualize the risk that options are currently pricing in, that risk is not just a function of what the market expects in terms of price movement, but it's also how much time we have left until options expiration. So a good example, or we can just look at this, the expected movement in a stock is going to be wider over time. That's because there's more things that could happen. Maybe a stock has earnings, maybe a stock could be in a trend, maybe oil crashes, maybe whatever. Okay, but we have much, much more certainty about where a stock will be one day from now versus where a stock will be a year from now. In fact, if you look at the implied volatility readings are on an annualized basis. If you've ever looked at the VIX is what? It's right around 16 right now. What does a VIX of 16 even mean? A VIX of 16 means the options market is pricing in that most likely the S&P 500 will be 16% higher or 16% lower going into a year from now. It's an annualized number. Now, you know, that could happen. The S&P could move 16% up or down in a year. But it's not going to move 16% up or down in a day, okay? Unless we have some sort of liquidity event, like a crash. It's probably not going to happen yet. But the near-term risks and the near-term perception of risks will always be lower over time. And that's what causes theta. That's what causes time decay. So if we take our bell curve visualization, as time goes on, that bell curve shrinks, which means as time goes on, the option values shrink. And if you're short options, then you make money. Here's why income trading works. You get to be long-term greedy. There is nothing wrong with directional financial speculation. I do it, and it's a lot of fun, but it's much higher variance. Okay, it's much higher risk relative to the rewards that you get. And if the stock market is very, very choppy, you're going to get stopped out a lot more, and you're going to get chopped around, and it's going to eat into your portfolio. One of the other benefits of income trading is that you don't have to stare at a screen for 6.5 hours a day. This does not mean you completely abandon your trading screen, but you can deal with a lot less noise. Okay, you don't have to stare at a trading screen every single day. One of the other beauties of this is that institutions cannot trade this strategy, or they cannot trade it well. It does not scale. So if you're a mutual fund or if you're a hedge fund and you're running at least, let's just say $50 million, these strategies don't work simply because of liquidity and slippage. You get to be a small fish, but you get to make outsized returns relative to hedge funds because you don't have liquidity risk. You can get in and out very, very quickly. Okay, this goes back, if you've ever played poker, one of the best indicators of your success playing poker is table selection, who you're playing against. And you know, if you're in the S&P futures market, you're playing against basically the best in the world, and you're playing against very, very smart people that have very, very smart algorithms. And yes, you can make money trading ES futures, but it's really hard because you have it's table selection. When you're doing income trading, you're actually providing a service to some institutions that require hedging. You're an insurance salesman. Okay, they cannot fade you as aggressively as you think. They cannot play against you because they're playing a completely different game here. Here's another reason why income trading works. It's non-correlated returns to directional trading. So if you just put a small amount of your portfolio towards income trading and you're already a successful directional trader, and maybe the market's in a range and you're getting chopped up, there's failed breakouts and failed breakdowns everywhere, like there has been for basically since the past few months now. If you've been doing income trading, it's helped to generate returns. And if you've been getting stopped out on a lot of your directional trades, this would have helped to buffer those losses. They're non-correlated returns. When you trade directionally, you are basically trading volatility. You're bullish volatility. When you trade directionally, the only way to make money is through stock price movement, and you want lots of stock price movement in your direction. Income trading is a bearish volatility strategy, so it makes for a very nice hedge against chop. It makes for a very nice hedge against reversion. There's three kinds of income trades that we're going to talk about: butterflies, calendars, and iron condors. Now, I got to double check to make sure we have enough time to talk about all of these. But as a quick aside, some people would say, oh, why not put sales? Why not covered calls? Why not credit spreads? Those are directional strategies. They have a lot more directional exposure than you think. And this may seem like heresy to a lot of option sellers out there, but basically when you put on a covered call, it's a very bullish bet. And theta doesn't matter as much as you think. Time decay does not matter as much as you think. If you sell, a covered call and you have a delta of 50 and a stock moves, against you, you're going to be down $50 per dollar move of that stock. If you look at the total time decay in that position, it's not going to be 50. It's going to be like 2 or 5. The directional exposure relative to the time decay that you get is much, much higher than non-directional strategies. Let's talk about how to make money with these. You make money if the market moves less than what the options price in. This happens a lot. This happens a lot more than you think. This is what we call consistent risk premium. This is why income trading works so well. You have hedge funds that require hedges, and they need to go buy hedges. And most of the time, those hedges have too much premium associated with them. And if you're on the other side, you can make money. This happens a lot more than you think. This is crucial to understand. Selling options just because the implied volatility is so high does not guarantee success, because you're not going to make money from the changes in implied volatility. It helps if you're right, but the majority of your gains are going to come from low actual volatility. What you'll find is when implied volatility is very, very high, often it is justified. Great example is if you're a net option seller and you're going into an earnings event and you say, oh, if I just sell, let's just say calls on Netflix, because that's one that ripped higher recently, or if I just sell a straddle or an iron condor on Netflix going into earnings because the premium's so high, well, how did you lose money? The actual volatility. There's a big difference there. Let's take a look at, this is a chart of the S&P since like 2010, and there are green boxes here. Those green boxes indicate ranges. They indicate non-trend. They indicate lack of direction. The stock market trends healthfully twice a year, basically. There's a good, in bull markets, and we are still in a bull market, much to the chagrin of many, many people out there. The stock market trends 2 times a year. The rest of the time it's garbage tape, and it's reversion, and it's range. Income trading makes money during reversion and ranges. The only thing you have to look out for is when the market trends, and you have to manage your risk through that. This is a pretty ugly sketch with my terrible handwriting, but this is basically the major trade-off. In any non-directional income trade you're looking at, this is what your risk looks like. So the blue line right there, the blue horizontal line, is your profit and loss. The green line, or that's the zero line. The blue line is the zero line. Your green line is the profit and loss right now. And then we have a couple Greeks to deal with. First off, income trades tend to be short vega, right? They tend to make money if the implied volatility of your short option goes lower. That's one way. It's not the way you make money, but it helps a little bit. It's an extra kicker. The way you make money is through theta, it's through time decay. Okay, it's through the shrinkage of premium on your short options. So that's the reward. Well, where's the risk? The risk is in what we call short gamma. So non-directional income trading, you basically start off with not a whole lot of directional exposure at all. It's called non-directional trading. But as a market moves, you start to accumulate directional risk. You start to accumulate deltas. If you start to see trending volatility, which means you start to see a big old rally or a big old sell-off without any kind of pullback whatsoever, then you basically become more wrong. Okay, the more a market moves away from your short options, the wronger you get, and that's where you get blowout risk. Okay, a very good analogy here is in physics. You know, if you try and balance, let's just say, a ruler or a pen on your hand vertically, and the pen starts to move away, or whatever balancing thing starts to move away from you, it starts to accumulate more gravitational force because the moment arm changed. I'm really nerding out here, but basically, in order for you to regain balance, you're going to have to readjust your position. This is crucial. These are not set and forget trades. Let's take a look at some examples. This is an iron condor. Okay, these are slides basically I scanned in. An iron condor is a combination of a short put spread and a short call spread. One of the reasons that you do an iron condor is because of something we call option skew. If the out-of-the-money options are very, very high in implied volatility, then you want to look at this trade. This tends to be the most common income trade that I see out there from traders. It also tends to be the most dangerous because you think that, oh, it's such a, the options I'm selling are so out of the money and they have such low odds of expiring in the money at expiration, then I'm going to be fine. Here's the problem. Let's say, one of the ways we figure out odds is looking at the delta of an option, and sort of a basic income or an iron condor is going to be a 12 delta short option, okay, where you short the 12 delta put and you short the 12 delta call, about 10 to 15 deltas. The delta is basically linked to the odds that that option will expire in the money at expiration. So you say, oh, it's just 12% odds. That's not that bad. Except those are the odds that it'll expire in the money. But what are the odds that it'll touch? What are the odds that that level will get tested? It's much higher. It can actually be 1 in 3. So think about the psychology here. You say, oh, it's got very, very high odds that it's not going to expire, but that's not the odds that it'll get touched. And if you put this on and one of those levels gets threatened, you're in a very ugly psychological position because you're now saying, oh, it just needs to revert. The market needs to revert and pull back to the mean, and then I'll be fine. But what happens here, because the market likes to screw over income traders, what happens here is that the market will squeeze and squeeze and squeeze and squeeze and squeeze near your short strike, and then you say, oh, I have to get out now, or I have to adjust. And as soon as you adjust, that's when the market reverts. Okay, there's some sort of magic voodoo going on here, but it always happens. One of the things that I like to do is I like to bias my iron condors a little bit to the upside. So here's an example in the Russell. This is what I call an unbalanced iron condor, where I sell more put spreads than call spreads, which means if the Russell rallies hard, then I can adjust the upside much more easily. What you'll find in income trades, especially iron condors, especially in stock-based iron condors, is that no matter what you do, you're always going to end up net short. And that is because of the option skew. There's some fancy things that go on here, but basically your call spread that you sell will always have more short exposure than the put spread sale has long exposure. Okay, so this is a trade put on in October. After 30 days, it has a return of 12%. An iron condor will not get you as much risk relative, or not much reward relative to your risk, because it's a higher odds trade. It's a much, much higher odds trade. Iron condors tend to be the simplest to understand, but they also tend to squeeze income traders very easily, because you have to understand the odds of expiration, what do they call it? Probability of success is going to be different than the probability of touching, okay? So you have to figure out ways to adjust your trade, to modify your trade to reduce that kind of risk. And changing an iron condor to an unbalanced iron condor is one of the techniques you can use. Let's now look at a butterfly. So if we talk about iron condors, okay, the reason we call it iron is because it includes both puts and calls. A regular condor can be a call condor or a put condor. Now, butterflies, okay, a condor is a combination of a put spread and a call spread sale, and the short options are on different strikes. A butterfly has short options on the same strike. Now, we can look at call butterflies or put butterflies, and we can also look at iron butterflies, where the short put and the short call share the same strike. this will have lower odds than an iron condor, but it will also have higher max reward relative to your risk. I'm a big fan of butterflies because you can build out these trades. Okay, so if we look at that lower sketch, that's what a condor looks like, and then the upper sketch is what the butterfly looks like. If you look at that green line, you'll notice that the green line hasn't changed. It's still the trade-off between long theta, so long time decay, and short gamma, which means an unbalanced trade if you become wrong, where the more wrong you are, the wronger you get. So this is a recent trade in the Russell. What you'll tend to find is that when you put on butterflies, they tend to start off net short. This was a slightly bearish Russell butterfly because the Russell at the time, this was back in right around Christmas, at the time was parabolic. And so I'm okay with putting a little bit more net short bias on this trade. But I don't want to hold on to that net bias the whole time. Okay, so the Russell then pulled back to, around 1180, 1175. And what I did here is I added a hedge, which got my delta back to flat. It became a better non-directional trade. And then I didn't have to worry about any kind of upside risk. And then I could just worry about theta. Specifically, this was a February put butterfly in the Russell, and the hedge was a series of call spreads in March, because going further out in time and buying verticals gets you basically pure delta without not a lot of time decay risk. This ended up being a 25% return over a 30-day hold. Okay, and these are not hindsight trades. I do run a trade service, and I call these out. These are trade alerts as well. Let's talk about calendars. Calendars are really, really tricky. They're the third kind of trade, and most of the time for stock indexes, they aren't necessarily the best trade. There's a lot more going on here. There's a lot more moving parts involved compared to looking at butterflies, compared to looking at condors, because you're not dealing with the same expiration date. You're dealing with multiple expiration dates. So you have to deal with things like term structure, which is basically the change in implied volatility over two different dates. There's a lot more black magic going on here with calendars than you think. The way you make money here is you're looking for the short option to decay much faster than the long option you buy. Calendars are also known as time spreads. They're also known as horizontal spreads. If you look at that lower right picture and you look at that green line, the game is still the same. Theta and gamma. And manage your directional exposure until the theta kicks in. This one is actually different because it is technically bullish vega, which means if you have a market that has very, very low implied volatility. So for example, if you're looking at the S&P and we have a VIX that is very, very low, you want to consider calendars over iron condors and over butterflies. Because if the VIX does rise, and if the implied volatility does rise, you're going to see a rise in the extrinsic value of the long option more on an absolute basis than the short option. Okay? This one's kind of hard to get, but the basic game here is the same. Theta and gamma, the time decay profits versus the volatility risk. So this is a very recent example. This is in Netflix. There's a very specific subset of trades that I like to do on stocks that gap up aggressively into earnings where the implied volatility becomes very low. So Netflix ran. A lot of option shorts got blown out into earnings. I think Netflix was trading around it was in the mid 300s, and then it gapped up and it ran up to the 420s. So this is buying the March-April 420 put calendar. If you don't understand how any of this works, just look at that white line. That white line is the same thing as what we talked about, theta and gamma. Now, this trade One of the things that I do on calendars and butterflies now is it's not a set and forget trade, and I don't put full position size on initially. Okay, I add to the trade as the stock moves. This is one of the best psychological tweaks that I've done for myself. So Netflix continued to run. It ran from, what was this, 428. It ran about 20 points higher. And then I added the 450 put calendar. And so this added more capital to the trade, and it increased our odds of success. Now there's some fancy things that happened with this trade. Basically the March options, the implied volatility came out very, very aggressively, and the April options stayed very, very high. I'm pretty sure April options had earnings in them. So, you know, there's some term structure gains here, but what happened? This ended up being a 25 to 40% return on an 8-day hold. Now this depended on whether you exited in the morning versus the afternoon. There were some very weird price changes here. But with it, this is a very, very successful kind of trade. Look at post-earnings moves. Look for stocks that have big moves on earnings. Look for them to have low implied volatility, and then put on some calendars. So let's hop back to Costa Rica for, I think we've increased the total viewership by about 100. For those of you that didn't hear, I had several near-death experiences in Costa Rica. I was riding in the backseat of a Toyota Yaris by someone who is not from Costa Rica, who was driving a stick shift up a mountain road, and there was a triple homicide involved, and it was a very close call for us. But I'm back in Costa Rica. I'm technically, quote-unquote, on vacation. And I'm saying, oh, if I just put on some income trades and I just leave them there, then I'll be fine. This happened to be, you know, at the beginning of 2013 when the market just ripped higher. And I got smoked to the upside. The worst kind of risk for income trades is non-reverting volatility. What you'll find for option traders, especially option traders that come from a math or engineering background, is that they always are skeptical about rallies. They're never, ever bullish. They always think that the market's going to pull back somehow. I used to be one of those. And that was just a function of the kind of trades that I put on. And I was very stubborn here, and I thought that if I just held through my vacation, I'd be fine. And I got smoked. And it didn't just damage my portfolio, it also damaged me psychologically. Okay? So it's crucial to understand, especially with any kind of trade, there's not going to be a black box trade. There's not going to be a set and forget kind of trade or investment. It does require you to put in the work. Don't get sucked into the lie that you can be some guy with a laptop on a beach, you know, just sitting there letting the money pile in. Now, you can, because financial speculation allows you to speculate anywhere in the world. You can, you know, you can travel and you can still make money, but you still have to be very aggressive. You can't let up with your trades. So let's talk about some of the mistakes that I've made and how you can avoid these mistakes. First off, believing that income trades are set and forget. Income trades are very, very dynamic trades, believe it or not. Remember, we're dealing with time decay, and we're dealing with the actual volatility in a market. If we see non-trending volatility, that's where you get in trouble. If you believe that your probability of profit is so high that you don't have to worry about the trade, you're going to have a bad time. Because the probability of profit, the probability that the short options will expire, okay, this is especially true on income trades or even if you do out-of-the-money short options. The idea that because you have the odds on your side, you won't get squeezed is not true. Because the probability of expiration is different than the probability that you're going to be tested at least once. Okay? And so it becomes psychologically jarring if you sell a bunch of out-of-the-money options or if you sell income trades or if you do any kind of income trading, that once you get squeezed and then you get stopped out or you adjust and then the market reverts and then it's not fun. So one of the things that I started doing is proactive adjustments. And I still don't get this right all the time. I still get stubborn. I still look for reversion and I look for pullback. So I'm not perfect with this at all. I also look to hedge directional exposure on the outset. This is especially true with iron condors rather, because they always tend to be net short. And if we're in a bull market and the market's ready to rally, you're going to end up with a lot of short deltas very, very quickly. So I look for ways to adjust my position. I can do unbalanced iron condors. I can look to pair it with some short VXX, which is an advanced trade. I also go with smaller initial size. This helps a lot. Okay, those unbalanced iron condors, I have extra dry powder. I have extra capital waiting at the wings because I know I'm going to get hit to one side or the other, and I want to adjust my trade as such. Mistake number 2 is not respecting Murphy. So who's Murphy? Murphy relates to Murphy's Law. Anything that can go wrong will go wrong. Just simply because of the natural volatility in a stock or a market, you're going to have a drawdown initially. You're going to initially be at a loss on your trade. It just always happens. You're going to end up being down 10% on a trade simply because of the natural volatility. As time goes on, as theta kicks in, the time decay will help to erase those gamma losses. But if you know what's going to happen, don't go full size initially. Do some smart scaling in. I do this a lot with calendars and butterflies where I don't put on a full position, but as a market moves, I slowly build out the position. The other thing at least I don't do anymore, I guess you could do it, but this is, I think it's good advice. Don't try and max out your profits. So if you go back, let's hop over to, let's just say this Netflix calendar.
Hey, Steven, I don't mean to interrupt, but you're looking at about 1 more minute left.
Oh, okay. Wow, I thought I had an hour. All right, we're going to hop through some really, really quick. Believing all risk is created equal. One of the things you want to look for indexes, wait for them to hit the upper Bollinger Band and stay away when the range is obvious. With all these solutions, here's some results. These are trade alerts that I've done with Investing with Options Premium, 38 of them total. I had 2 losers. This is in 2014. 2 losers, maximum loss, -4%. Total aggregate win, 610%. What that means is if you put 10% of your portfolio into each of these trades, you're up 60%. Average win is 17%. So we're going to hop through some of these slides really quick. I'll just get to the offer. Here's some income trading you can get from me. Okay, this is the offer. Income Primer Part 1 and Part 2. It's about an hour each. You'll learn about flies versus condors. You'll learn about weekly income trading and tiered calendar trading. You also get IW Premium access for 14 days. With IW Premium, you get nightly videos, you get video training, you get the chat room, and if you act now, we're going to do some live income trading on Wednesday, talking about current market action, what's working now, and trades to consider. All of this, including all of those training videos, you can get it at investingwithoptions.com/income. It is $14. $14 for the training, the 2-week access to Investing with Options Premium, direct access to me and our chat room and our nightly videos, and the income trading workshop we'll be doing this upcoming Wednesday. So if you're interested in that, go to investingwithoptions.com/income.